Welcome to the Gatewood Wealth Solutions quarterly market commentary broadcast. This is John Gatewood, and with me today is Aaron Tuttle, our Chief Investment Officer. Welcome, Aaron.
Thanks, John. I'm glad to be here.
And today we have a very special guest on our broadcast, Bill Friebel, who is the Vice President of John Hancock Investment Management. Welcome, Bill.
You know what?
Thank you, John.
Glad you could join us. I know technology is a little bit challenging when we're all in different places, but I wanted to tell the audience that Bill is a regular speaker in the investment management community, and we are happy to have him here with us today. One interesting fact that I learned about Bill is that his first job out of college was as a teacher at Chaminade High School here in St. Louis. So we won't ask you the where did you go to high school question that everyone uses to define who you are. But thank you for being here with us today. So we continue to experience this incredible, unprecedented journey as we navigate the coronavirus spread, skyrocketing unemployment, closing and now reopening the economy, and plummeting oil prices. So today, we'll first take a few minutes to hear from our Chief Investment Officer on how our portfolios are doing. And since this is the first quarter in which clients are receiving their quarterly performance reports, which they can find on their GWS portal, Aaron is going to give a quick snapshot of what clients can see. Then our guest speaker, Bill Friebel from John Hancock, will give us a brief presentation on key market intelligence relevant to our economic views. We'll then follow up, so hang on for this, it'll be a lot of fun, a Q&A session with our two speakers. So Aaron, can you lead us off?
Absolutely, but first, let's handle the compliance matters. Securities offered through LPL Financial and member FINRA SIPC. Bill Friebel and John Hancock are not affiliated with LPL Financial and Gatewood Wealth Solutions. The economic forecast set forth in this material may not develop as predicted, and there could be no guarantee that strategies promoted will be successful. We're still wondering why we brought in Bill, but let's review the performance on the different strategies. This is the first quarter update, so let's review the performance for that time period. The equity benchmark was a negative 22.81% as of the end of the quarter. This was just past the quarter low set on March 23rd, which was approximately down 33% from the beginning of the year. As our listeners may recall, green indicates outperformance. All equity strategies were ahead of the equity benchmark. One of the goals of our strategy is to go down less during prolonged sell-offs. This was a rapid sell-off, but we did manage to do better than the benchmark. To repeat the joke from last quarter, it's hard to get new jokes. This is similar to saying you did not die on the operating table. It's certainly not a ringing endorsement, but very important nonetheless. Now, some strategies are 6% ahead of their benchmark. That is 6% that does not have to be earned to get back to the previous account values or account highs. As stated in our weekly updates, the bond strategies are not doing as well as the bond benchmark. This is because we do not have a large allocation of long-dated government paper, which we feel carries enormous interest and inflation risk. Now we're into the end of April, which means we have 1/3 of the second quarter in the books already. So we're looking at the year-to-date performance. The market has continued to move up. Another goal is to do better during market uptrends. The blended benchmark as of Monday was at negative 18.39%. This is a slight gain from the end of the quarter, but look at the account strategies. We are 10% ahead of the bench. They're moving up at a faster pace over this time period. Now, we like to say our strategy is playing singles and doubles baseball. We're looking for consistent return. We're not trying to hit home runs because the risk needed to try to do that it would just create wide margins relative to the benchmark. But to stick with our baseball analogy, we consider the results a grand slam. We will celebrate the win, but we do not consider this something that is just easily replicable. We just were in the right position through both the downside and the upside and had little transition drag or need to make changes. As we've said in previous events, our strategy doesn't really work well on the first initial turn when we're more aggressive, or on either the bull market going into a bear or the bear market going into the bull. But since we didn't have to make changes to the strategy, we've done really well. We were simply in the right securities. Also, the qualified bonds are gaining against the benchmark with the addition of convertibles, but there's still a lot of ground to cover to catch that the bond benchmark. Now, the 1 year trailing has similar spreads as the year to date. The returns are still negative, meaning account values are still below the value from 1 year ago. The 3 year trailing is significant. The equity benchmark is basically flat over the last 3 years, with marginal gains of 0.23% per year. In comparison, Taxable Mutual Fund has a compounded rate of 5.2%, or approaching 20% holding period returns over a 3 year time frame, despite coming out of a bear market. This demonstrates the power of good active management. And here is the spreadsheet we use for each of the time frames. Now we call out a 60-40 blend below. Despite struggling relative income strategies, a 60-40 tactical mutual fund portfolio is still ahead of the blended benchmark over each time period. Now, everyone should be receiving a quarterly performance report in the GWS portal. Here are some examples. We wanted to go over the first page to help our clients familiarize themselves with the reports and to find their actual return. So it's not just us talking about a hypothetical model, as well as that blended benchmark. The blended benchmark is on an account by account basis. You need to review each account separately to see this benchmark. You can't see it just at the general overview on the entire household. You have to go into each account. Now, these quarterly performance reports are samples, but they are samples of real accounts, just with all the personal identification and account numbers removed. It's one of our quality controls because we do audit everyone's accounts relative to the model that they are in. So this is an all equity tactical mutual fund report. The pie chart on the left will indicate the percentage of equities, alternatives. Right now there's a gold position, fixed income, and cash. The account value summary will indicate the returns for the accounts. In this example, we are looking at quarter to date, or the end of the first quarter to April 20th, basically 20 days. The numbers may be too small to see, but it does show the account is up 10.2% since the beginning of the quarter versus the benchmark return of 6.2%. This demonstrates the higher returns generated thus far through the rally. The first column results are graphed in the account performance section. The orange line that you see is the account value, and the blue is the benchmark value. So you can see that spread visually. The year-to-date performance of the account should be similar to the results we just reviewed earlier in the year-to-date slide. This is the case. Now here is the qualified wide mode. The first page is similar to tactical mutual fund, and we'll move on to a tax sensitive, which added more excess return relative to the benchmark than the other two strategies reviewed over the last 20 days. Now, this is helpful since we did not make many changes last year due to that tax liability concern that we reviewed in the previous quarter event. And we were lagging the benchmark. We think it's great to make some ground from last year. Now, John, I'll turn it back over to you.
Thanks, Aaron. That was really terrific. I mean, as you say, this was a grand slam. We have done very, very well, but this is not something to be expected because typically you can't have that type of outperformance without taking significant risks, as you say. So we're hoping just to at least continue our singles and doubles. So now I'm going to turn it over to Bill Friebel. Take it, Bill.
Thank you, John. And first of all, thanks for having me. I really do appreciate it. And I always really enjoy my interactions with Gatewood Wealth Solutions. And one of the reasons for that is, and I'm not just saying this because I'm on the call with you guys, you have a lot of brain power in your team. And obviously everybody on the team has the alphabet soup of designations behind their names, and that is very impressive, but you also are able to really blend in the real world to go along with that. And the conversations are always very stimulative, and that's always a lot of fun for me. Before I get started, I do just want to maybe kind of make some self-deprecating jokes here, because I got a little bit of a chuckle out of it as we were getting started. As I logged in for this event, I tried to turn my camera on, and it said that the host of this meeting, Aaron, had blocked my video. And I'm sitting here actually in a jacket and tie, and I'm pretty sure that the reason Aaron did that was because when we did the test run yesterday, he saw how I was dressed then, which was pretty much standard work from home attire. So I think I know why he did that. But anyway, I got a good chuckle out of that. As far as market intelligence goes, this presentation I'm going to share with you, I thought it would be good to maybe just share how we come to this and maybe explain a little bit about how John Hancock is structured. We are what is known in the industry as a manager of managers, and many of our underlying investments are managed by outside managers. We do have a number that are managed in-house, but in areas where we maybe feel we don't really have the expertise, we will go out and hire another third party to run that particular asset class for us. And we actually have a relationship with 29 different institutional and boutique managers. And so when we put out a market outlook or any kind of quarterly outlook, it's not always just our opinion. We do have an opinion internally at John Hancock Investment Management, but we also try to blend that with that network of opinions. So it's not just one voice. It's not just our view. It's really a combination of those. And actually, if you could go to the next slide, please. As we do go through this, one thing I thought I would mention is just the way to read this. You'll see off to the right-hand side of the page, you'll see that in a number of different U.S. Equity categories, you'll see a range from bearish to bullish. And you'll see overall in U.S. equities, we are fairly bullish right now as we sit at these current valuations, at these current levels of the overall market. But if you look at that range of the blue boxes on there, that's kind of showing the view of that overall network. The dark blue box is the consensus view. If you totaled up all of the votes, if you will, for bullish to bearish, the darkest box is where most of those votes fall. The lighter box does still, there are some folks that do have maybe a less bullish view. And so there are some in the network that maybe fall into that category. And then if you look at the little yellow or gold triangle, that is the Hancock view. So you can see that overall right now, we're fairly bullish on U.S. equities, favoring large cap, favoring mid cap, somewhat neutral on small cap. In terms of growth versus value, we're somewhat neutral there. And so, that we again, overall favor U.S. equities in this environment. Next slide, please. I think what's important to note, though, is, there's no doubt that we are probably in for some very difficult economic news over the next few months. A big reason for that, obviously, is all the layoffs we've seen that have come as a result of COVID-19. Stat came out actually just yesterday. Obviously, we had more jobless claims this week at about 4.4 million. That now actually has erased, if you go back over the last 4 weeks, we now have about 26 million individuals who have been displaced as a result of COVID-19. And that has erased all of the job gains since the Great Recession back in 2008. So devastating numbers, very awful, both personal and economic news for a lot of those individuals. And so there's no doubt as this continues to play out over the next couple of quarters, it is going to be very difficult to look at some of this news. However, the question kind of becomes, is this going to be a very sharp recession and short, or will it be a little bit more prolonged? If you could go to the next slide. One of the things that we think is very important to stress is that you really do have to separate economic data from market reaction to that data. And it's often said that the stock market is really a discounting machine or a discounting mechanism where it looks through the present and is really discounting the future. And if you think about it, if you were to buy a share of any company's stock today, you aren't really buying it for what has already happened or what we think is going to happen tomorrow. You're really buying a piece of that company's future revenue stream or that future earnings stream. And so often the market really looks through this awful data, and we may have already seen some of that. I'm not necessarily willing to put a flag in the sand and call a bottom in the market like we saw back in March 23rd, just a few weeks ago, which at least currently has been the bottom. But we've seen a pretty significant rally off of that level, even with some very devastating economic news. And what this chart is showing you is that when we've had at least 30% or greater declines in the S&P 500, the near term and really the long-term returns have actually been quite good if you started to buy into the market when it was down 30% or more. And we look at some periods from 1968 to 1970, 73 to 74, 87, 2000, and 2007. And after that initial drawdown, in every 1 year period, 3 year period, and 5 year period, you'll see that the market was up fairly substantially from that point going forward. I think the other thing that's important to note is the vast majority of those returns actually come typically in the first few months. You look at that difference between the 1 year return and then the 3 year and the 5 year, a significant portion of it came really in that first year after that immediate drawdown. Next slide, please. Now, we do think if you're looking at the United States, we think it's important to maybe take a barbell approach, and I think this does coincide largely with Aaron's views and how he's positioning portfolios, but we certainly like technology, we like communication services, really kind of more so for an offensive sector allocation, but we also think it's important to blend that with more of a balanced approach and maybe have some sectors for defense. And you'll see that we highlight consumer staples and healthcare, two areas that we think play some fairly good defense. And also, given the stay-at-home as well as the healthcare crisis, probably stand to benefit somewhat from the next few months of economic activity. I do want to spend just a couple of minutes on this slide. Look at that bar chart in the very middle of this slide, and you'll see the S&P 500, and you'll see the index representation there. And you'll see technology at about 25%, healthcare at 15%, financials at 10%, and on down the line. I really want to stress that. I want you to, if you can, kind of sear that into your memory for just a moment, because I'm going to refer back to it in a future slide. You go to the next one, please. Now, if you look at our views on international equity, we're a little bit more defensive there, and you'll see that we're kind of leaning toward bearish overall on international equities. European developed markets, Japanese developed markets, we're fairly bearish there, and then we're somewhat neutral on emerging markets. Now, there's a few reasons for that. If you could go to the next slide. So first off, you'll see some of the sectors that we like in the overall, this is really more of a developed market index that we're looking at, but we favor playing a little bit more defense in those markets. So healthcare and utilities, but I want you to look at that index representation. And remember, I just talked about how the S&P was constructed, and you might recall that technology was the top sector. And it's a big difference in terms of the overall sector representation or index index construction versus the S&P 500 when you look at foreign markets. And we think that's a very important thing for investors to understand. You know, if you just bought an index and think you're getting really a representation of the same sectors in every country, that's really not the way it's put together. Every index, for the most part, not all, but for the most part, all indexes are really weighted based on overall market capitalization or number of stocks or size of stocks that make up that index. And what's interesting is when you go around the globe, you really don't find the same types of companies in every region. And so the United States has some great tech companies. You know, we have companies like Google and Amazon and Microsoft, you know, that are big, massive, very profitable companies in what we think is going to continue to be a growing sector going forward. But if you look at this bar chart to the right-hand side of the page, this is the All Country World Index X the United States. You'll see technology is pretty far down on the list and represents less than 10%. And in fact, if you just bought that index, you end up with 20% financials, which may not be the overall exposure that you want. So we think it's very important for investors to understand what they're owning if they just buy an index representation for a particular area. Next slide, please. Another important factor when it pertains to really any investment, but very specifically foreign equity investments, is what direction the dollar is heading. And if you look at this chart, I'll just try to make it simple, a lot of squiggly lines on there. But essentially, when the dollar is weakening, that's been very, very bullish for foreign equity returns. Conversely, if the dollar is strengthening, that's a headwind for the foreign investments in your portfolio. So it really is very important to have a view on the dollar, to try to be as accurate on that view as you can, and then structure your portfolio according to what those currency fluctuations are going to, what effect they're going to have on those investments. Next slide, please. Now, with regard to fixed income, you'll see overall we're fairly neutral, you know, and we do kind of break that down into a number of different areas. Next slide, please. There was actually some very good money to be made really in the last, call it 2 to 3 weeks in the fixed income markets if you were willing to take on substantial risk, which isn't necessarily warranted. But you did have a situation where spreads, and I don't want to get too wonky on this, but that's basically just the amount that is charged or bond issuers have to pay above treasuries, depending on the level of risk that that bond has. But what happened is you had a situation where everybody was running for the perceived safety of US Treasury bonds. They were selling everything else. So as those prices were going down, the yields were going up. And you were having a situation really back around that March 23rd date that I spoke about earlier, where you were seeing those crazy volatile swings of 10% a day in either direction. And you had a market that was really teetering on really some liquidity issues. Really in some areas wasn't functioning properly, and the Fed came in and started buying really essentially everything in sight. They started buying things that they'd never bought in the past, and they came in and really provided a bit of a backstop to that. Now, that being said, those spreads that I talked about have come in, and that means that if you bought during those crazy times, you did actually make some money. But we really don't necessarily think there's really a lot of opportunity going forward, much like what Aaron said before, because of some of the inflation and potentially interest rate headwinds that we see going forward. Next slide. But it is very important to understand that the job that bonds do have in your portfolio. And while they may not necessarily provide fantastic returns in the near term, or maybe even some long-term numbers going forward based on where we are at these interest rate levels or these yields, it is important to understand that they do provide that ballast in your portfolio for those times that I just talked about before, when the market is completely irrational and you have that incredible flight to quality taking place. that's all of a sudden when bonds make sense in your portfolio and will outperform cash because you have people flocking to them and really piling into them. So again, just understand why they're there, even if we don't necessarily think they're the most attractive thing to be in at any given time. Next slide. Okay, that's a really nice slide. I forgot that one was in there. Why don't we just stop there, and I'll turn things back over to John.
Great. Wow, that's really great stuff. And this is the part that everybody likes the most on our broadcast is the Q&A session. So we have had a flood of questions coming in since we started. And one listener asked the following, and I think this one is more geared towards Aaron. One thing we are experiencing is a flood of fake news regarding the virus. Everything from extreme fear to conspiracy theories to others saying COVID-19 is not even as severe as the flu. How can we be confident in our views when there are so many conflicting opinions out there?
Well, I think that it's not so much fake news as it is that so few people actually understand what is going on, whether that's an epidemiologist on the nature of viruses. There's a lot to learn. This virus itself is also very new. So we're all operating out of models and trying to understand and test different theories, all of which are supported by anecdotal evidence, not actual studies. Now, there have been some studies that have been coming on where we definitely have better and more information than what we did, let's say, in March. What tends to happen with viruses is as we get more information, we have better testing. We find that the prevalence of the virus is much wider than what was feared, because the symptomatics, those that are going to the hospital, were the first ones recorded, and you would see a high death rate versus those known to have it. The other thing that I would say is very well known now is the speed that this virus moves, and it moves a lot faster.
Very fast.
But I wouldn't say there are certainly going to be people with their own agenda. They're going to push that. We also have confirmation bias as humans. So we will find that anecdotal evidence that bolsters our view, and then we'll discredit ones that don't. But I don't know that you could say that there's a lot of fake news around this virus, as much as you could say there's just a lot that isn't really well known about.
Right. I would say that at least from our perspective, we really try to look at the data.
Right.
Yeah. So we don't go in here with an opinion one way or another, especially since we're not scientists.
Right?
But it's really just the data.
Right. And even that data, there's been differences in methodology, difference in testing. When we first started modeling this, the testing, if many listeners recall, the U.S. got a late start on the testing. We had to remove regulations that were put in by the FDA for previous eras, not the rapid. So then all of a sudden, the new cases that we were comparing, well, the way that they were coming to the data changed. So you couldn't look at the same benchmark and projections. Well, now, since April, the CDC, and we are not qualified to say whether the methodology is correct or not, but has actually opened up or loosened the requirements to label somebody as a death from the coronavirus. Well, if you loosen that up, you would see more deaths. Now, it may be a really good reason. It comes out of the CDC, definitely not saying that there's any type of medical fraud, but the change in methodology in the way that the deaths were recorded has become more liberal. So it's not surprising to see a turn back up after where we were peaking before.
Yeah.
This may be the more accurate way of recording it. And the previous data that was sound data that we had built models off of
maybe it was underperformed.
Underreported. So we just don't know.
So another viewer or listener asked a question that's really addressed towards both of you. Bill, maybe you can start. It says, seeing that there are 26 million new unemployed citizens, as you mentioned, how long will it take to get these people back to work? And will we ever get back to the record low unemployment we were experiencing before? So Bill, can you comment?
Yeah, I think I'll take the second part of that question first, which is, will we get back to that record low? And one of the things that has been really happening since 2000, and it's really just been more of a demographic shift, is, as the baby boomers have retired, we have actually seen the overall number of workforce participants somewhat decreasing just because of the number of people coming out of the workforce as they retire. So that had been a contributing factor, not to mention the job growth. I don't want to discount that, but that had been a contributing factor to that very, very low unemployment rate that we had been seeing, which is, again, just really a demographic trend. So I think that continues to hold true going forward. Now, on the other side of that, which had been occurring in greater numbers, and we will start to see it playing out, but you, of course, have the millennial generation starting to hit its stride, and more of them coming into the workforce, which will backfill that. So you will have a bit of an offsetting effect of it. But again, I think because of the demographic trends, it probably definitely helps us to get back to those record unemployment levels. Do we get back there anytime soon? That was kind of the first part of the question. I think that is, probably, I would say, million, billion, or $1 trillion question at this point because of the amount of stimulus that's being pumped into the economy. And the first thing I would say is it's definitely not going to be immediate. I think we all know, for those of us who have lived through past recessions and past periods where people are laid off, employers don't bring people back immediately. They bring people back based on the level of demand they have for their goods or services. And so there's no doubt it's going to be very gradual. But if we do have a V-shaped recovery, I think that clearly gets us back to that point a whole lot faster than certainly what we would have otherwise thought. So I'll turn it over to Aaron for his thoughts.
No, I agree. I think looking historically at recessions, you do have the slow pace, but I think what's different this time is we've created very generous unemployment benefits for individuals, especially on the lower income levels, and there's a term called moral hazard in economics, and I think that's playing out or beginning to play out. We're seeing headlines is there are a lot of the lower income ranges that are making more on unemployment because the U.S. Federal government put in additional funds for benefit above states. So they're looking at about $1,000 a week per person, which is near the median income for household here too. So these don't end until August. And as a rational person, if you can stay home and make more money by a couple of $100 a week, it's going to be really hard to entice some of those workers to come back. So it's not to say that's the wrong thing. Economists will argue back and forth, but just on the logic of it, it makes sense to stay home and collect a bigger paycheck to not work.
Aaron, just to add a little bit more fuel to that fire, I just read an article earlier today where an employer who had received her PPP loan to keep her employees intact was facing the ire of all of her employees because she was actually keeping them on the payroll. They were upset because they, just to your point, they would have collected more money in unemployment had they would otherwise.
Right, that was out of Washington. I saw that.
Right.
So on another note, I was reading today about Southwest CEO Gary Kelly, and he's been answering questions that have been posed by his 60,000 employees via videos worldwide. And he's generally an extreme upbeat leader, but he said, "So what's going to happen to us?" That's the question he's getting from his employees. The honest answer is, I don't know. We've never experienced anything like this in our lifetimes. Do we give up? Well, of course not. We fight like we've never fought before. We fight to defeat the virus, and we fight for our customers, every single one. They're precious and we need them. He does add, and don't ever be rude. Many companies will not survive this, and it may be through no fault of their own. Institutions will be lost that took years or decades to build. But Southwest is too precious to lose. All of us, we are the stewards and the protectors of what's been built over 50 years, and must guard the treasure that has been entrusted to us with all our might. So the three of us were talking yesterday about this whole fact that business will not be the same when we are fully back. So starting with you, Bill, what changes do you envision in the way business is done, industries that may or may not come back, and others that may benefit immensely from this?
Yeah, as you mentioned, I think every time we go through a crisis, really throughout our lives, we may not know it at the time, but we can certainly look back on that crisis and say that's the point at which things changed in some way. And there's no doubt in my mind that we're going to see significant changes on the other side of this in many ways. I do think, just what we're doing right now, I think virtual meetings, this type of interaction will be a much bigger part of everyone's daily lives. We've been forced to get used to the technology, and we found out that it's pretty user friendly. It may not completely replace face-to-face. It may not completely be the same as getting together in person, but there's no doubt that will be a much bigger component of both personal and business interactions. So, what does that lead to? It probably leads to less business travel, less airline miles, less hotel points. At the same time, I think you're going to look at companies looking at their overall real estate footprint and how much do they really need. This has been the grand experiment that no company was really ever willing to take on themselves and have all their workers work from home and see if productivity still stayed relatively high. And based on everything I'm seeing, it has stayed very high. So when a company starts to do the cost benefit analysis and say, okay, if we could get, let's say it's 85% of the same productivity we were getting before, but boy, we could cut out a significant portion of our real estate costs. I have to think that those decisions are already being discussed right now, where maybe instead of 100,000 square foot facility, maybe that gets scaled back to a 60,000 square foot facility, and the ripple effects of that throughout the overall economy. So that's an area I think that could absolutely be hurt is commercial real estate in a lot of ways. Obviously, the one thing we haven't talked about, which is kind of crazy through this, if you look at what's happened in oil over the last month, that in and of itself, had you completely taken COVID-19 off the chalkboard for discussion, the drop that we saw in energy prices was enough to push the United States into a recession in and of itself. So the fact that we have that on top of what's going on with COVID-19 right now, that's another area that I think there's going to be some challenges. Now energy is not going away, oil is not going away, but there's no doubt if we stay at oil under $20 for a sustained period of time, there are absolutely companies in the oil patch that are not profitable and probably will have to be filing for bankruptcy, and doesn't mean that it goes away in any way, shape, or form, but it probably means there's a lot of consolidation there to take place.
Well, that's a very good point, because one of the questions that we had from another listener is, you keep speaking about a V recovery. I am less confident in the short term. I think there is still a lot of things that can go wrong before the economy is up and running that may cause the stock market to drop again. The oil thing is certainly another contributor. What would have to happen to change your mind about the shape of the recovery?
Well, so that one's directed to me. I would say the market selling down from here in a significant way, so it's no longer the shape of a V. would clearly be an indicator that the V-shaped recovery.
Well, other than watching the market become a W or something different,
Right.
what else would we see?
So I'll just go back to why we think that V-shaped
I
recovery
think
is likely.
that's a good way to look at it.
And that is because of the unprecedented amount of stimulus, both monetary and fiscal. One of the things that routine listeners are aware of is that we watch the money supply growth. And then Bill also had the Fed balance sheet. And this is a faster, more steep growth than what we saw in 2008. And the point of doing that is to levitate financial assets so that they are that we separate that from what the economy is seeing, to get stimulus, to get cash going, to increase demand. All of that is designed specifically to separate the financial markets from what's actually happening in the economy.
Well, that's one of the things that we've talked about in terms of how difficult it is to monitor or even think about the market, because it's as if they've financialized the markets,
Right.
rather than having true price discovery through economic activity, business cycles, and so on. Now you've got this massive input of a variable that is really not been captured previously because we haven't had this
right.
in
So
the market.
If we did not have the stimulus plan, the market would be further down for sure, because the economic situation is it looks fairly dire. We have a lot of people in unemployment. Bill had mentioned the issue with oil production. Now the drop in price in oil usually is a tax cut, but that the production of oil is also added to GDP. Then you have the moral hazard that we were talking about on people being unemployed and not getting that. But that is a great example of why we think the markets will still tend to what is known climb that wall of worry, is because yes, we have high unemployment, but what we don't have is a reduction in the spending from paychecks. Many people actually have a higher paycheck than they did before, all the while where people are producing less because many people are not able to go back to work. So the stimulus should find its way into capital markets first, and that's why we've seen such a sharp rebound. That being said, if a second wave comes back and we think the lockdown is going to be more prolonged, especially if the government isn't entering in and adding more stimulus to that, you would definitely challenge the idea of a V-shaped recovery. So far, we've seen that V-shaped recovery over the last, I'd say, week. There's been a stall, which is normal market movement. The people that have been buying the stocks, especially those that entered, those traders that got in early, let's say on March 23rd, they probably want to harvest some of those losses. You want to test these valuations, because there's, as good as models are, they don't actually capture everything. So there's some safety there. But we'll continue to watch, and we have a process and a system that helps guide us moving money to areas that are working. And if we'll eat the crow on a V-shaped recovery not happening. If it starts to be a W or a U, and our signals tell us to make changes, we'll certainly make those changes and not just stick there stubbornly hoping to be right on a V-shaped recovery.
So one of the things that we heard yesterday or the day before was Dr. Fauci saying that we have a potential for an even larger breakout in the fall. Now, again, this falls back to the initial point about, fake news. And it's not, it's fake news, it's really opinion of professionals on data as they see it. But one of the questions that we have is, what do you see happening in the market if a second wave hits us in the fall? Bill, do you want to take that first?
Yeah, I'll take a crack at it. And, I think the easy answer is to go back to what we've all kind of touched on up to this point, is that, really unless you were around, back during the Spanish flu, we really don't have a great frame of reference for this to rely on in terms of what this could look like. I think if there is good news in that, if we did have a second wave of this, no doubt we're going to be substantially more prepared for it. Obviously, a lot more ventilators, hopefully by then a lot more treatment options, and also just an overall healthcare system that has been girded for something like that to occur. In addition to all of the social distancing events that we've been taking on in the last few weeks, and I think becoming more accustomed to that. But I think there's no doubt if you did see a substantial increase in the number of cases again, and I've even heard and again speculation it being the key word here. I've even heard some speculation that you could get a greater wave in the fall simply because of the time of year that it's hitting us. And again, who knows if we will even have that wave, so please don't put any stock in that. But I think there's no doubt if you did see a substantial number in cases, and we do have to go right back into the same type of stay-at-home economy that we've dealt with over the last few weeks, clearly there would be both a market and economic reaction to that because, as Aaron has mentioned, as I have mentioned so far, what both from a fiscal and monetary standpoint the government is doing is really trying to fill the hole to bridge that gap from where we are from here to get to there, and there being the other side of this. If all of a sudden we get to the other side and we still have a much further way to go, I think there's no reason to think that you shouldn't see another significant market reaction to that.
So Aaron, what are your thoughts? This is another question that came in from our audience. What are your thoughts on the banking sector as they take on the responsibility of the loans coming in from the stimulus and the potential for greater losses on loans already booked by businesses that will fail? And that ties into what Bill was even showing on his slides about how the financial sectors in the foreign markets are not very good.
Well, yeah, so there's a lot of detail in there to kind of unpack to answer that question. But banks make money on spreads, what they pay the depositors and then what they get when they lend the money out. And when we look at these low interest rates and low spreads, it's very difficult for banks to make money here. That's one of the reasons that value, which has historically been considered, you get a risk premium where you would be compensated more, has not shown up. The other sector that's typically a value investor is the energy companies. The value has really struggled. Financials has struggled as well, maybe not as much as energy. They are benefiting from the current stimulus package because they are processing these loans and they are getting paid a loan fee to do that. So right now, let's call it a commission on the loans that they place is bringing some extra revenue into financials, and one of the reasons they have moved up. Now on defaults, this is where there is some squishiness because the Fed is going and buying exchange traded funds, not just of government-backed securities or government securities, but also going into the corporate bond market, including junk bonds. So they are able to go in and purchase bonds that may be distressed or worth less, and basically bid up the price of those bonds and take them on their balance sheet. So there's a lot to that. If we did see a lot of record defaults, we've talked about modern monetary theory as an academic argument that is being proposed since 2008 and the lack of inflation showing up. Well, that theory is being tested right now because that is what we are going through. That's one of the reasons you've seen such an unprecedented stimulus package coming out of Washington. You would think if we haven't seen inflation, because we're still dealing with these deflationary mechanisms or phenomena that is happening in the market, the Fed would continue to step in and buy these bonds. And there's, as well as A precedent set in Japan where Japan bought equity indexes as well. So once again, a lot to unpack whenever it comes to things.
Well, you mentioned the word ETF. Bill, you talked somewhat about ETFs in your presentation, and we had talked about this yesterday about how the performance of the ETFs in the energy market, the USO, but then what is the impact of ETFs, or let's say just passive investing going forward as we go through this creative destruction of companies that may not come back?
John, I thought I might hear this question again, so I'm prepared for it. But I think a couple of things just to talk about, the exchange traded fund market in general. And I think one of the big kind of boogeyman fears out there that in the markets kind of talked about as it pertained to ETFs in general was if you got into a period of extreme market turmoil, extreme market turbulence, that you could have some of these ETFs that all of a sudden started to not act like the underlying stocks that they own, that could kind of take on a life of their own and move in directions that they really shouldn't move, and give investors really a completely different return profile and completely different risk profile than what they thought they were signing up for. And if you go back to again, kind of that March 23rd period and the week leading up to it, where you had these extreme moves of, as I mentioned before, up 10% one day, down 10% the next day. In general, I think that the good news in that regard was that they did do generally what they were supposed to. They moved in line with the underlying securities, so that part really worked. The second part of that, though, is you did mention one of the oil ETFs, USO is the ticker for it. And I think in a lot that by the way, I heard was the #1 traded ETF on a trading platform out there called Robinhood, which tends to be this kind of online environment where a lot of younger millennial investors, for the very first time they're investing, they go in and they buy things on it. And if you're thinking to yourself, wow, oil's really cheap and I want to buy some oil, I'll just go buy this ETF. The problem is those ETFs were buying futures contracts. They weren't buying barrels of oil. And there's a big disconnect. And if some of you saw earlier this week, oil, a price, for a barrel of oil didn't go to zero. However, some of the futures contracts not only went to zero, but they went below zero because commodities traders didn't want to take delivery of the barrels of oil. So they were essentially paying people to take them off their hands. And if you had these ETFs that were in these futures contracts, in some cases, they had to completely restructure the ETF to avoid failure. And so I think the first thing is very, very important to understand what you own, which kind of brings me to the next point, which is what I was talking about before. When you do start to look at index representations or index construction around the globe, #1, it's very important to understand you're not getting the same thing in every ETF that you own. The construction of that ETF is far different from one to another. Foreign versus domestic, large cap versus small cap, growth versus value. Very important to understand what you own. But then this also goes back to another point that you brought up earlier, which is what businesses are going to be here and prosper in the post-COVID-19 world, and also what businesses may not be here at all. If you just go out and you buy an ETF for a broad-based stock market index, there's a very good chance that if you bought that right now, there's going to be a number of companies, a number of industries or sectors in there that are just not going to be what they were before all of this, and you still own it. And so I think, again, it's very important to understand what you own and then ask the question, do I want to own that?
So I want to direct another question to Aaron here. As you know, President Trump signed the newest bipartisan interim coronavirus bill today that totals almost $500 billion. And before you know it, we may actually be talking about real money. but it's a new money to support small businesses as well as more funding for hospitals and testing. Now, Mitch McConnell, I was reading, was interviewed by the press this week and said about this, let's weigh this very carefully because the future of our economy in terms of the amount of debt that we're adding up is a matter of concern. Can you comment on this?
Well, yeah, so at Gatewood Wealth Solutions, we have said that we believe the biggest risk for our economy and for clients building wealth is the size of the national debt. So we agree with caution being a big component of this. What else I think is interesting with Mitch McConnell, so that they have definitely provided a lot of stimulus through this. We total it all up, we get the number around $11 trillion now with this new additional funding. But the question, and the other side of the aisle would like to help support states, especially the states with high debt loads, which tend to be bluer states. And Mitch McConnell said, well, no, I think that it would be appropriate to consider bankruptcy for these, that should not be out of the question. And they should not be rewarded for the amount of debt that they have taken on by bailing out through other states. And though I agree with that statement that when you are loaning money to somebody as the loaner, you're the one that should be taking the risk on bankruptcies. I do find it a little hypocritical at the same time that the federal government, Mitch McConnell being a major leader in that, has not really been great stewards or not racked up a lot of debt themselves. So there's a lot of politics that are going on. I don't know that they're even behind the scenes. There's a lot of politics that are at play here. And you can find one person saying one thing that you agree with, but notice that it doesn't seem consistent with what they are doing elsewhere whenever it benefits their party.
Bill, what are you hearing over at John Hancock relative to the amount of debt that's being taken on through the stimulus package?
Yeah, agree 100% with what Aaron just said. It's going to be the long-term cost of the crisis that we're going through right now. And I would say a few things to just throw into this conversation. Both parties hate deficit spending and hate increasing the national debt when they're the party that's out of power. It always seems like when they're in power, they really just don't talk about it anymore. And I think that's really been a challenge, is that you really have not had either party really look at the debt meaningfully and really try to come up with a plan to deal with it. And if you do start to look at the long-term costs of this, and Aaron has already touched on it, it's the way you deal with this is all of them lead to curtailing growth. It's either higher taxes, it's less spending, it's higher borrowing costs, all of the higher inflation. All of these things are not good for people who are trying to build wealth or preserve wealth going forward. I would, in this, obviously, I'm going to make a comment here that first off, I have to qualify and say, this is something where you really need to speak with your financial advisor at Gatewood Wealth Solutions to make sure it's appropriate. But, I'd almost look at if you had any money that was in a qualified account like a traditional IRA or a traditional 401k, you may want to consider looking at an opportunity to convert that to a Roth, pay current level taxes on it at a time when the market value might be lower than what it was a while ago, so that the overall tax amount is going to be less. Because I gotta believe that on the other side of this, it's really difficult to believe that our tax rates are going any lower.
I think that's a great point. And the other thing I like about your comment, Bill, is how important planning goes around wealth. So we've run out of time. In fact, we went a little bit longer, and I want to first of all thank you, Bill, and you, Aaron, for your enlightening thoughts today. You know, one of the things that we've discussed is what life will look like 1 year from now and how accurate or inaccurate our forecasting has been as these events rolled out. So we're kind of looking forward to that. Another thing that we learned and what we have always considered as part of a client's financial plan is that black swan events and economic turmoil do happen. This will not be the last one. So at risk of sounding like a broken record, this has highlighted the importance of having a cash target for every family that is relevant to each one's life stage. And we also say that it's not what you make on that cash that matters, but what that cash allows you to make on everything else. So as a reminder, Gatewood Wealth Solutions is on a mission to share our expertise with families, helping them become and remain financially self-reliant. So we want to keep that money even during times like now so they can give purpose to the money. So if you have any other questions, please reach out to your lead advisors. And until next time, thank you for listening in to the Gatewood Wealth Solutions quarterly market commentary broadcast.
Thank you, John.